Stock picking can, and often does, deliver market-beating returns for those who can do it properly. And we're not talking about simply buying shares in big stocks like Apple and Amazon when the prices are down.
Proper stock picking is a super complicated subject and is more likely to lead you towards investing in a small cardboard box company than a blue chip tech giant.
If you're a beginner buying stocks, we bet you've probably only thought about share price movements, maybe the dividend, and at a push what the company does. But these alone are not enough to pick stocks successfully.
There's way more to it than that. It's so intense that we're still learning ourselves. Having so far focused on large blue chip dividend stocks and globally diversified ETFs, we'll continue to advocate holding 70 to 85% of ETFs in the core of our portfolios, but stocks are where the big value is to be found. If you have the skills and time to pick stocks that perform. And since quitting our jobs last month, we now have the time.
This is part one of a two-part mini-series looking at how to find and invest in stocks that can beat the market average. In this video, we'll get you up to speed on the time and effort involved to trade stocks properly. We'll simplify the key trading concepts in plain English and tell you what kind of stocks we're looking for when we trade. Let's check it out.
Welcome to Unshackled.com, the investment and finance channel and website that sets you and your finances free.
That was Andy and I'm Ben, and if you like what we say, hit the like button and click subscribe. Trading is a job. Making a living as a market trader is a job in itself. Don't be tricked into thinking that all it takes is a glance every now and again at a free trading app.
A trader's day revolves around the hours of the stock market, but unless you're trying to time the market, which we're not, you don't need to do too much during that time other than place a few trades. The real work comes from thoroughly researching 20 or so companies each week and choosing one or two to actually buy.
How much money do you need to start trading? Any amount if you're using a free trading platform like Free Trade, because there are no trading fees eating into your trades.
But to make enough money to make a living by trading, you'll eventually need more like £100,000 minimum. And that's if you're really good at it and can make 20% returns on average and able to weather a few storms by falling back on other incomes or cash savings. Most people are unable to do this consistently.
Whilst learning the ropes, start small so you can maximise your skills while minimising the downside. You can ramp up the stakes and start scaling your returns once you've proved to yourself that you can do it well.
What kind of stocks? We prefer smaller ones with market caps of up to around £1 billion, but preferably in the low hundreds of millions of pounds. These are reasonably established companies with lots of opportunity for growth. Small caps are also much easier to understand. Large companies' business models are notoriously complicated. And we have accounting and financial analysis experience and still struggle. You need to understand the stock that you're picking through and through. That's right, no big name blue chip stocks. The stocks that we're interested in, for example, can be found on the FTSE 250 and the FTSE small cap indices in the UK and the S&P small cap 600 index in the US.
Be prepared to lose a lot of money. You'll make a lot of it too if you do it properly. But to make an omelette, you need to break a few eggs. Trading stocks using fundamental analysis is far more volatile of an activity than simply buying and holding well-diversified ETFs. But being less diversified is kind of the point of stock picking. You're trying to beat the market average by picking only the best growth stocks.
Do it within your ISA. The capital gains you'll hopefully be making as you grow your portfolio means you'll be attracting tax if you don't use your stocks and shares ISA allowance.
And when the time comes to draw down on your pot and take an income from it, you'll again wish that you had used an ISA, because otherwise you'll be getting taxed left, right and centre.
Limitations of free trading platforms. To trade efficiently, you want real-time prices, but don't worry about this as a beginner. One downside of using a free trading app is that the prices quoted are not always live and they generally don't show the bid-offer spread.
I recently got caught out on Trading 212, who sold me gold at 1% higher than the price was showing at when I clicked the buy button. Not a massive problem for long-term investors, but it is a problem if you're doing a lot of short-term trades.
We would start out using the free trading platforms as the benefits of not paying anything for your trades would very likely outweigh the risk of losing out due to opaque share prices. But eventually you'll want to use a big traditional broker like Interactive Investor, which you can sign up to with the link below.
You will have better visibility over the share price you pay, and as you get more advanced, you can take advantage of their level 2 data, which shows all the quotes on an order book. If you want to start small, check out our free trade and stake sign up bonus offers on Unshackled.com, where you can bag a couple of £100 of free shares just by using the links.
Concepts a stock picker needs to be familiar with. Number 1, spreads get better with size. The bid-offer spread, the difference between the buy and the sell price of a stock, can be a hefty initial loss on a smaller company's shares. Stobart Group, valued at £181 million, has a spread that we saw move between 1.4% and 2.7% while we were researching this video, so they can be volatile too.
If you're buying bigger FTSE 250 or FTSE 100 companies, the spread tends to get more negligible as there is a lot more trading activity going on with these stocks. Royal Dutch Shell currently has a spread of less than 0.1%. However, the problem for us is that it is the smaller companies that we will be most interested in as stock pickers, as those are the ones with the best opportunities for growth.
Number 2, market makers. To maintain liquidity in the stock market, some financial services companies agree to act as a guaranteed buyer of last resort. So if you want to sell a stock, there will always be someone there to take it off your hands. This gives them a lot of power in the market as they can actively manipulate buy and sell prices of the liquid stocks that they transact on. This again most impacts the smaller companies that we're interested in as stock pickers.
Number 3, exchange market sizes. You would think that you could buy as many shares as you want in a company at the quoted price as long as you can afford it, and that selling shares is also as easy as clicking the sell button. But there is a potential limit unique to each stock, called the exchange market size, set by the market makers.
If you want to buy over this limit, you may not be able to, or you may be charged a crazy high price to do so. With large stocks, this is unlikely to ever be an issue for most private investors.
If you owned more than the exchange market size, then you may be unable to sell all of your shares at once without being offered a price akin to daylight robbery.
For instance, Tesco currently trades at around £2.20 a share and has an EMS of 10,000. This means you could own no more than £22,000 of Tesco stock before liquidity might become a problem. If we wanted to buy £25,000 of Tesco shares, we'd get the first £22,000 at market rates and then potentially be robbed blind for the extra £3,000.
Likewise, if we already owned £25,000 of Tesco shares, we could sell 22 grand at market rates, but then potentially get a rubbish deal for our remaining 3 grand, if anyone wanted them at all. Many traditional brokers quote the EMS on the stock's info page.
Price earnings ratio. This tells you how many years it will take to get your money back from the company's profits based on current earnings. Not overly useful in isolation, but good to compare against similar companies in that sector. Usually the lower the better. Companies with a higher PE ratio might be expected to grow their earnings faster, so a higher PE might be justified.
Question of the day. Are you interested in hearing more from us about stock picking? Let us know your thoughts in the comments below, and keep an eye out for part 2 coming very soon.
Thanks for watching. On this channel we talk a lot about personal finance, investing and all things money. And if you want to see more great content, please click the subscribe button below.
This is moneyunshackled.com. See you next time.